In this video, I will share with you all the details of my top secret trading strategy with which I created a 1.5 years long consistent positive trading track record. And if you watch it till the end, you will be able to understand how it works so that you can make $1 million profit from trading or more. Let's go. Hello and welcome everybody. My name is Alex Duvidari, and in this video, I want to show you my keep it simple, stupid strategy. The reason why I chose that name is because complexity does not equal success. Now, still, you need to have a working structure. And I'm known as the data guy, the statistical edge guy, the 7 building blocks guy, an ex-hedge fund manager that learned to trade like a professional from professionals, right? And that is how I approach my trading. And maybe just one or two more words about myself before we dive into that very strategy and why actually also it is of value, because it's working. For simple, that's a very simple reason. So maybe one or two more words about myself. Look, I have a background in the professional financial industry. I've worked for an investment bank. I worked for a hedge fund. I've won multiple awards. I've handled billions of dollars in transactions and, tons of millions in funds. But at some point, I actually quit the industry. And the reason I quit the industry and why today I'm showing people, everyday people like you, how to beat the market and actually win consistently for decades is because my focus for myself, for my life, the choice that I made was I wanted to be with my family. I was not interested in a corporate rat race, regardless of the money you could make there, or the power you would get, or the status, or whatever. I chose a life where I can be close to my family, witness my kids as they grow up very closely, and these things, I valued those a lot more. So that's why I sympathize with everyone that wants to break out of any rat race in order to be able to enjoy that kind of life with their dear ones, right? And so that is my why, and why I'm actually, interested in, because it worked for me and it wasn't always good for me. Like, I will not go through all my story. A lot of you may actually know it, but I literally came from below zero, from debt and a lot of losing accounts and so on and so forth. So everyone can do it, but it's important that you do it the right way, right? You don't want to be right. You want to do the right thing to achieve the result that you're looking for, right? So let's move forward. What is this? This is a track record, ladies and gentlemen. It's one of the rarest things that you find in the trading education industry. And for whatever reason, I'll leave that to your imagination. So what you see here is that exact strategy that I will present to you here in this video. It has produced this result. So you can see there's around 1.5 years of consistent, profitable trading, month over month over month. Of course, the strategy has drawdowns. Of course, the strategy has better months and weaker months. But nonetheless, this is a proof, a indisputable proof. Numbers don't lie, right? It's not a cropped out trade, a profit, a flipped account, a screenshot of something. This is independently verified. It runs on DarwinX, which is a regulated platform where investors can actually put their money to that strategy. And that's why it's very important that you understand this kind of quality of result is something completely different to what you otherwise see on social media. And the core principles that I stand for, that I've learned in my institutional career and that I actually teach also to my members, is the 7 building blocks, right? And everything needs to be data-based and has a statistical edge, which means that it's proven to be profitable over a amount of trades. And you need to have clear rules for all of these building blocks, and everything that you do must be rule-based. You do not gamble, you do not take guesses. You basically follow a method. And even that method at the end of the day is an educated guess, because nobody knows what the market's going to do. But you can narrow things down so well that you can have a higher probability of winning than losing, especially, again, over a longer and larger amount of trades and time. You get it? And that's very important that you understand that. A lot of people have a short-term mindset. They try to get into wrong type of strategies. They over leverage, they underestimate the stresses, the leverages again, and all these things, and then they just end up being in a gambling type of relationship. That's absolutely not what I do, is not what I teach, and what I absolutely not advocate. I stand on the complete opposite of that, because trading can be such a great way of going through life when it works and when you do it the right way. And here's another proof of the same strategy. You can see that also works on a smaller account. It's also like from November 22 here, running on IC Markets, track record, trading privileges, everything is verified, and it is the exact same strategy. And I will teach you today the exact details of that strategy so that you can, ideally be able to do it yourself. So let's move on from here. One more thing. Look, I know that maybe my approach may sound to you boring, too slow, grandpa trying to teach kids, but honestly, that's the only thing that works. None of these guys here are actually traders. They're content creators, and they make promises that they cannot make. It's mathematically impossible. Make 10,000 pounds a month. Yeah, that's only 333 pounds a day. Sure, I can make that math, do that math, it's not a problem. But, you cannot know what exactly you're going to make in a certain month. Why? Because it's the market that dictates the environment. You can only have your patterns within the markets, your rules and your statistical edge play out, but the distribution of that is completely random. And anyone that wants to say it's different and he can clearly tell you what they're going to make in every month, any month, it's just wrong. It's wrong and lying to you. But anyway, let's get to the strategy. That's a lot more interesting, right? So why I called it keep it simple, stupid? Again, because too many people overcomplicate things. For example, let's take order blocks or whatever. Like, there's a million ways to define what an order block is. And most people actually don't define what they trade. They just have a bit of an idea of what it is. And this is where the problem is. If it's not precise, if you're not clearly knowing what you're doing, if you don't have quantifiable, measurable parameters, then all you do, again, is gamble. You're doing a different trade every single time. So how can there be consistency? It cannot, really. That's the problem here. And when I decided about the strategy, the point was I needed to find a strategy that fits my lifestyle, because I wanted to have little screen time. I didn't want to be at the screen all day long and, scalp the hell out of the London session or whatever. No. And I wanted to reach a annual target of 20%. Now, of course, if you wanted to leverage more, you could aim for more. That's a number that you can decide for yourself. But nonetheless, the thing is that if you set your target too high, the risk that you will take will also be too high. And the question is what do you do if you get taken out in between? Then you're literally at zero and everything you've done was for nothing. So when your target is in a reasonable place, then you can really survive for a long time and you can accumulate mass, a lot of capital trading that, right? And what we're doing here is a combination of technical analysis. Yes, technical analysis. I have done a lot of critical statements about technical analysis because many people use technical analysis on its own. And that doesn't work, because technical analysis is just one aspect of multiple aspects that you need to be taking care of if you want to solve the problem of trading. And in this case, we combine technical analysis with the 7 building blocks of strategy development to make sure that we have a statistical edge, right? A positive expectancy, data-based. And so keep it simple, stupid. No SMC, no Wyckoff, no 10% in 5 minutes or any of that. It's a confirmed statistical edge, back-tested, and we have a track record, live traded, verified, that clearly confirms that. Let's move on. So what is this strategy all about? It is a trend following strategy. I look at the weekly, daily, and the 4-hour chart. I'll explain that in a second as well, some more. The average holding time is around 1 to 3 days. Sometimes you hold trades a little longer, but that's what it is. I look a lot at support and resistance. Yes, again, technical analysis. I use round numbers a lot. Quota theory, for anyone that has heard about it. Why? Because these numbers just continue to have a cleaner entry and exit for targets and for entries in the combination of all of these things, especially when you backtest it. And I add some other confluences. I'll explain also what I actually mean that. One of the 7 building blocks is an additional confirmation. That would be it. And the PMT is also an additional confirmation. I use some of the parameters that you see in there. The prime market terminal is a great tool. It's not my tool, but I know the guys are great guys, and I've been involved for many years with them. And but it's not even necessary. It's not even a must for the strategy. But I want to give you everything, the whole thing, how I do the strategy, how it's being executed. I think an important part of this is a dynamic trade management. So there is a discretionary aspect to how the strategy is traded or how the trades are managed. And that has to do with volatility, market structure, and things of that nature. So you need to be a trader in order also to execute the strategy better and better and better. And I always aim for at least a 1 to 2 risk reward. Not a 1 to 10, not a 1 to 50, not a 1 to 2. Of course, sometimes targets that hit are even further away and make more money. But nonetheless, this is what I'm looking for when I'm looking for trades. Okay? Everything is always rule-based and statistically sound. Let's move on. So we start with how do we define the trend? So we look first the weekly, then the daily, then the 4 hours. So we go down from, a higher to a lower time frame. Nothing, no magic here. And when all time frames agree, then I have a basically 10 out of 10 trade setup from a trend perspective. I may take trades also that have a lower, let's just say, maybe an 8 out of 10, a 7 out of 10 in terms of how strong the whole signal is that I see here. But nonetheless, if they all agree, then obviously from a trend perspective, that's the best. That's what I'm looking for. And I have one trade example. It's from July 10th. That's my birthday. It's my birthday trade, a beautiful trade that actually worked out well. And I want to explain you the exact trade, the exact analysis, and everything so that you understand the strategy that the track record that I showed you is completely based on. Okay? Next one. So what we do is we count the highs and lows on the weekly. What I do is also I ignore the wicks. Why? Because they just create a little bit more, it's messy. It just creates more confusion. So you just look at where's the candles like here. You can see this is a low, this is a high, this is a higher low, there's a higher high, right? And so this is on the weekly. You can see that this qualifies as a bullish structure, right? Because simply of this structure here that you look at. That's number one. Number two is, it's also important now when we look at the weekly is that no candle actually broke the structure. You can see again, here's the low, right? Here's the next high. Again, ignore the wicks. Here's the low. Then you have here going up, and then even that pullback got well supported back here. So we don't see that any candle close has broken the weekly structure. So as you can see, the weekly structure is extremely important for me in order to determine if the trend is still intact. Okay, that's for me a decisive point as to the trend directional strength that is in place here. Okay, then the daily, then also we use the daily to confirm the trend as well. So again, you can see here that we see here, for example, that we had the structure going down, but again, this support was not lower than the low of the structure that we had here when this move started, and again then actually had here a new high that went to this structure, and then this structure again broke higher, and that makes then the trade as you see it here. We entered here basically and then took that trade up here from the 147.50 right level that you see here, but this 147.30 actually, and the target 148.50 in this case. Again, those are the round numbers, and I'll explain that also in a second. That's a simple example of a trade. This is the daily chart. Then one more time, look, sometimes again all these smaller time frames don't completely agree with the daily time frames, but or the larger time frames, but you want to ideally see them do. This is the best trade setups that you get. And then again, the discretionary aspect is to decide that would you take a trade sometimes where it's not aligned as perfectly. But again, here you have the 4 hour, right? And you see the structure again confirmed, right? You have this low, you have this high, then we're going lower, then we have high, then this low, and then we see how the structure builds back up, right? And this is the structure that we're looking for, and then essentially also resulted in the trade that we wanted to take, and this is the profit, then the profitable trade setup then was executed. Now, support and resistance is the next. First was trend, second is support and resistance. What we do here is we basically form zones, not levels. Why? Because levels are too thin. They're too especially on a bigger time frame, it's impossible to narrow it down to one price only. So we look at zones. And for example, we see that there are two zones here that have had stronger reactions. Stronger reaction typically is a wick, right? And at least 3 of them is what I need in order to create a zone. So you can see like this zone here had 1, 2, 3, 4, 5 of these reactions. And this zone even here has also 1, 2, 3, 4, right? So those are zones that are then interesting for me to keep an eye on in terms of when and where I want to enter the trade. Again, this is on the weekly. This is a EuroCAD example, by the way. And so the way I quantified it is clearly 3 strong reactions minimum to have a zone on the weekly. Okay, so again, it's not like maybe 1, maybe 5, maybe 10, maybe 8, 3. Why? It's back tested, you know, and live traded. So that's why it's 3. And then again, I confirm these zones also on the daily chart, right? Like you see now, we clean them up a little bit as we go on a smaller chart, right? On a smaller time frame. And in fact, we do the same thing then also on the 4-hour to fine tune these zone levels a little bit more. And that gives us then clearly like the idea of where we expect a market reaction and we anticipate a market reaction before it actually takes place. Because once the price goes where we want it to go, because as you can see, we will not, if this price, for example, had just continued to go up and broken this level, it would have invalidated this trade because I want to trade on a pullback. I don't want to trade, that's also part of the strategy, for example. I don't want to trade like a breakout here, right? So that's why I need to have this pullback, but this pullback needs to hold essentially a zone that I had and also be around a round number. So in this case, 147.30 is the level, okay? Okay, now you could say like, but quarter theory is only 0, 25, 50. Well, it's not necessarily quarter theory, it's round numbers a lot more. And I'll get to that also in a second. So this is how we look at support and resistance. That's the next ingredient for that trading strategy. And then we add quarter theory levels or round numbers, as I write here, on the 4-hour for entry and stop loss based on these levels, zones, and market structure. You see, like, you know, we have these zones, right? And we also have the, clearly here we can see that this level held. So this is what I mean by market structure. That pullback came to this zone. We had the 147.30 as the round number. We would set the stop loss somewhere around here, the 147.0, right? Like, and then again, we want to have a 2-to-1 target, right? And this is the level that we've seen here, the 148.50. Again, another round number that has also been a zone up here. You see that? So, and that's really how we trade this trade. And we enter round numbers level on a 1-hour chart, buy limit 147.30. You can see it here, right? So again, here you have the zones for the market structure. I'll get to these 2 EMAs in a second as well. As I said, this level is important for me because if that has just rushed through, it would have invalidated a trade. I would not have taken one. I want one on a pullback to one of the zones. And ideally, I want this to be actually on the EMA. And in this example, it's fantastically perfect. It was on exactly the EMAs, actually both. Next step. And that is the 200 SMA and EMA dynamic support on the 4-hour chart. Important is that what I want is to see that it's a dynamic support. The name actually, like what I'm saying, says exactly what's it about. It should hold as a support, right? And you can see here that we saw first resistances, right? And then we broke through that. We traded above them. And then the second one held. We had the market structure and to the zone. And then boom, we go up. Also important, here on the 1-hour chart, we see that we've been trading above both EMAs repeatedly with these zones. So that gives me, again, then an additional support that we are trading in a bullish structure, and I'm just waiting for the next other things to align before I enter my trade, right? Why do I enter the trade here and not here? Because only here is when my probability for this move to happen has increased so much more compared to any of these others, because there's so many more things in place than there used to be here. And that explains why technical analysis alone doesn't work. You need to stack technical analysis with statistics and other rules that actually then create these opportunities, or for you the ability to see these opportunities and to trade them. And from a target perspective, again, we set targets for stop loss take profit based on zone and round numbers. So we entered here, the round number for the target is 148.50. And again, this is also trade management. So it's based on a bit also then on discretionary decision as we reach that target. Do we want to take the profit? Should we, just take half of it? Things of that nature is something that is in this strategy discretionary. But you can clearly see also the stop loss, that it was around here, the 147 area, and that's important that, we play with these levels as a zone again, because that has shown me in my backtesting and then also in my live trading that this is the most reliable outcome. And again, when you trade, you can only trade probabilities. You cannot trade something sure. So that's why you have to stack the probabilities in your favor to make it work. And another thing that we do is we add from the prime market terminal additional confirmation. But also, in all fairness, this has the lowest priority in the total analysis. So if the other parts that I just explained, if they are all in place, then I might ignore the prime market terminal. But I look for seasonality. The stronger it is, the better. So I definitely like that. Even if it's like really strong, then I will have a more, or have more confidence in the trade. Then pattern prediction is also pretty cool, because especially when the pattern prediction supports the trade idea analysis, meaning it shows, for example, a pullback to the level that I want to see happen first before I enter the trade, then I like that a lot too, so that it does that. And the DXM is also an extremely valuable tool here, because it gauges the retail positioning in the same pair. And I look at like how strong are retail positioned in the pair, because what I want to do is I want to trade against the retail majority. Again, there's nothing personal against most people, but most people lose in trading, and that's why when all are crowded on one side of the trade, and that's the opposite of the trade that I want to take, plus all my other rules in place, then my probability of winning that trade is just skyrocketing. And that's how you create a track record like this. Simple. Keep it simple, stupid, guys. 7 building blocks, statistical edge, clear rules. You train also doing all these things, and it becomes second nature to you. No long screen time. You don't need to, be stressful about anything. And sure, you have drawdowns in between, but you clearly have your risk reward, everything is in place, and your risk management, your trade management, and that's how you create a result like that. And I hope that this video really shows you clearly that there is no magic, there's no secret ingredient, there's just like a process, a working process that brings, you cannot argue with math and data and rules and statistics. These things are real. So bring them on your side and you will have that kind of result. And I want to end this video with one statement. Look, the discipline you develop in trading will create a legacy of success for your loved ones. So the reason why I chose trading in my life was to live a family's life and a self-directed, independent life. And this is how I see trading. I don't see trading as this flashy, whatever, gamification sort of thing that it become, like a lot of traders these days, they think they're rappers or something. So that's not what I chose. And this is why you cannot be successful in trading without the discipline and that kind of process. And this is the end of the video. If you liked it, I'd be really happy to hear from you. If you have any questions, try it out for yourself. And until then, thank you very much. I'll see you in the next video.